I have watched a lot of mergers in my lifetime. Some made perfect sense on a balance sheet and still failed in real life. Others looked risky on paper and turned into golden compounding machines. But every so often, a deal shows up that isn't just about price, synergies, and cash flows. It's about power. Netflix's $72 billion move to swallow Warner Bros. Discovery, with its HBO crown jewels and deep movie library, is one of those moments. The numbers matter, yes. But the signal it sends about who controls attention, narrative, and culture, that is what really moves markets. When a president steps in front of cameras and says a deal of this size could be a problem, he isn't just talking to lawyers. He's talking to investors, executives, regulators, and voters all at once. He's putting a spotlight on the antitrust risk, the market share, and the political optics in one sentence. In this case, Trump is warning that combining one of the largest streaming services with a major studio and premium network could give Netflix too much power. He didn't say no. He said, this could be a problem. And in my world, that phrase translates into a new line item on every investor's mental spreadsheet: regulatory uncertainty. Regulatory uncertainty is like a slow leak in a tire. You can keep driving, but your margin of safety shrinks with every mile. Here, the leak starts with antitrust. The deal doesn't have to go through the Federal Communications Commission because neither Netflix nor Warner Bros. Owns broadcast stations. That sounds like a shortcut, but it still has to face the Department of Justice's Antitrust Division and potentially the European Commission and other foreign regulators. Every one of those entities has its own agenda, its own politics, and its own view of what too big looks like. Each additional signature needed is another coin flip for delays, conditions, or outright rejection. Investors love to model revenue synergies and cost cuts. They love to draw hockey sticks on subscriber charts. What they usually don't model is ego, political ego, corporate ego, regulatory ego. Netflix's CEO reportedly made the pilgrimage to the White House before this deal, just like other executives have done. Get close to power, secure favorable treatment, avoid nasty surprises. That strategy can work for a while, but once the president publicly flags a deal as a problem, the game changes. Now, regulators have cover. Senators smell headlines. Rival firms start whispering. Antitrust becomes not just a legal question, but a public narrative. And public narratives can kill even the most strategic deal if they grow loud enough. The irony is that Netflix will insist it faces intense competition, not just from legacy studios, but from YouTube, social platforms, and every digital screen competing for your time. They will argue that even with Warner's library and HBO, it still fights for attention against free content, short-form videos, and global rivals. And they'll have a point. But antitrust is rarely decided on philosophical nuance. It's decided at the intersection of market share charts, political wins, and whoever has the stronger story when the cameras roll. Right now, the story being planted is dangerous. The biggest streamer wants to become an entertainment superpower, and the president is hinting that it might be too much. That alone can tighten valuations, raise discount rates, and make boards more cautious. I've learned this: when politics walks onto the field of capital allocation, the cost of capital quietly rises, not always in the models, but in the minds. This merger is not just a negotiation between Netflix and Warner shareholders. It's a negotiation between Silicon Valley, Hollywood, Washington, and regulators on multiple continents. Every handshake, every quote, every press release is part of the price. And the more those prices depend on political favor rather than hard economics, the more fragile the whole structure becomes. Now, step back and look at the broader pattern. This is not the first time in recent years that a major media merger has been dragged through a political and regulatory gauntlet. Paramount's deal with Skydance, for instance, only went through after a very public and contentious dance with regulators and the administration. That deal came with its own set of conditions, lawsuits and concessions, including payments tied to grievances over news coverage and commitments about changing corporate policies. None of that showed up in the original investor decks, but it all became part of the ultimate cost. In the Netflix-Warner case, the dollar figure alone, $72 billion up front, and more than $82 billion once debt is counted, already sets expectations sky high. That price assumes not just a successful merger, but years of smooth integration, steady subscriber growth, and pricing power in an increasingly crowded streaming landscape. It assumes regulators will permit that level of concentration with only moderate conditions. It assumes consumer tolerance for higher prices, fewer independent competitors, and even more content locked behind one ecosystem's paywall. When you stack all of those assumptions together and then layer a presidential red flag on top, you don't get a conservative investment. You get a leveraged bet on political mood, cultural tolerance, and regulatory philosophy. I've always believed that concentration cuts both ways. On one side, efficiency, shared technology, unified marketing, bigger negotiating power with talent and suppliers. On the other side, fragility, one scandal, one regulatory shock, one cultural backlash, and suddenly your synergies turn into liabilities. If audiences begin to feel that one company controls too much of what they watch, or if creators feel squeezed, you can see boycotts, strikes, and content migration. When a merger like this is framed publicly as a potential anti-monopoly nightmare by high-profile lawmakers, that sentiment risk multiplies. It's not just about what regulators think. It's about what the public and the political class are being encouraged to believe. That's why, as a long-term investor, I don't just ask whether the combined company will be big. I ask whether it will be loved, trusted, and tolerated at that size. Because markets can price in growth. They struggle to price in resentment. And resentment tends to show up late, suddenly, and violently in the stock chart. In this second phase of the story, the dynamics start to look more like a courtroom drama than a business plan. On one side, Netflix and Warner argue that together they can compete more effectively, produce better content, and create long-term value for shareholders. On the other side, politicians and regulators ask whether viewers will have fewer choices, higher prices, and weaker alternatives if this merger proceeds. And hovering above all of it is a president who has already shown he is willing to intervene directly in major corporate combinations. Keep in mind, this administration has already reshaped how corporate America interacts with Washington. Executives have learned that they cannot treat regulators as distant referees anymore. They often have to treat them as active players on the field. When a media giant needed approval in the past, it might hire lawyers, lobbyists, and consultants. Now, CEOs fly to the White House, sit down with advisors, and try to secure blessings before they even finalize term sheets. Netflix's leadership reportedly did just that. A pre-deal visit, a conversation, an attempt to get on the right side of power. That's not illegal. But from an investor's standpoint, it's a sign that the rules of the game have changed. The more deals depend on personal relationships with political leaders, the more volatile the outcomes become. A single change in mood, a public statement, or unrelated dispute can spill over into the regulatory process. In this case, Trump's comment that he will be involved in the Netflix-Warner approval sends a clear signal. This is not just a staff-level antitrust review. This is a stage. And when deals become stages, you have to factor in the cost of drama. Drama stretches timelines, invites grandstanding, and tempts decision makers to treat a merger as leverage in broader political battles. Look at what happened with Paramount. Approval eventually came, but only after the company agreed to pay millions linked to grievances involving news coverage and campaign narratives, and after it accepted conditions touching on controversial internal policies. That was not simply a financial negotiation. It was a negotiation over influence, reputational scores, and cultural direction. The lesson for investors is simple. The headline valuation is just the opening bid. The real price includes every concession extracted along the way, many of them only visible in footnotes and side agreements. For Netflix and Warner, the hidden price could show up in forced divestitures, content licensing obligations, or limits on exclusive arrangements. Regulators might allow the merger but demand that some assets be sold or that certain content be shared with rivals, weakening the strategic logic that justified the $72 billion in the first place. They may impose behavioral remedies that constrain pricing, bundling, or data usage. Every one of those constraints chips away at the rosy synergy projections investors love to quote. And don't forget the global layer. The European Commission and other foreign regulators will not simply rubber stamp a giant American entertainment platform consolidating even more clout. They will ask what this means for local competitors, independent producers, and cultural sovereignty. In a world where content is also soft power, a merged Netflix-Warner is not just a company. It's a channel for American storytelling. Other governments may view that as a strategic asset that needs boundaries. Extra conditions overseas can reduce the global scale advantage. Netflix is banking on, again, lowering the real economic payoff relative to the sticker price. Meanwhile, competitors are not standing still. If you are a rival studio or streamer, you have every incentive to pressure regulators to slow or block this merger. You will quietly argue that such a combination would suffocate innovation, reduce diversity of voices, and hurt consumers. Some of those arguments will be sincere. Others will simply be self-interest dressed up as public interest. Either way, they add friction. And friction in deal-making is like sand in an engine. You can still move forward, but you burn far more fuel than expected. The political stagecraft will intensify as hearings, statements, and media coverage pile up. A senator calling the deal an anti-monopoly nightmare isn't just making policy. They're auditioning for clips that will be replayed across platforms. Every sharp line complicates the approval process. Every accusation of monopoly power pushes regulators closer to imposing heavy conditions just to prove they are tough. From an investor's point of view, the question becomes how much of this is priced in? And more importantly, how much of it can the combined business model absorb before the promised returns get diluted into mediocrity? In the third phase, you have to ask a deeper, less comfortable question. What does it mean for democracy and capitalism when news networks, movie studios, and giant platforms end up negotiating directly with political leaders over their very right to exist in their desired form? Paramount's settlement links with the future presidential library and commitments about news practices were not accidental details. They showed a template. You want your deal approved. You accept terms that reach beyond finance into editorial and cultural decisions. If that template expands, it turns mergers into moments where power over information is quietly traded. Apply that lens to Netflix and Warner. This is not just a platform buying a studio. This is a streaming giant that can shape what millions of people watch, merging with a legacy player that has decades of storytelling influence. The resulting entity would have leverage over franchises, news-adjacent content, and the broader cultural mix people consume daily. When a president says he will be involved in deciding whether that level of concentration is acceptable, it is not just an economic event, it is a political and cultural event. Markets respond to that by repricing risk, not always instantly, but persistently. For advertisers, this merger could create a new behemoth with unmatched reach across scripted series, films, and premium streaming. That sounds attractive, fewer partners to negotiate with, more data, broader campaigns. But some brands will worry about being too dependent on a single distribution gatekeeper. Others will worry about backlash if activists frame the deal as dangerous concentration. If a narrative takes hold that one company has too much control, some sponsors will hedge by shifting budgets to diversified platforms or user-generated ecosystems. Revenue that looked locked in the models can leak away under reputational pressure. For creators, the story is equally double-edged. A combined Netflix-Warner could offer enormous resources, global reach, and the promise of big-budget projects with global distribution. But if bargaining power tips too far toward the platform, writers, directors, and producers may fear getting boxed in. Prior waves of consolidation in media already triggered labor disputes and strikes when workers felt the economics no longer rewarded them fairly. Add the perception that this mega merger was waved through or weaponized by political players, and you have a cocktail for renewed unrest. Work stoppages and creative slowdowns hit content pipelines, and content pipelines are the lifeblood of any streaming valuation. Investors often underestimate how much of a streaming business's value is intangible: trust with creators, goodwill with regulators, and emotional connection with subscribers. All three are at risk when a deal becomes controversial. If subscribers believe that consolidation will mean higher prices and less diversity, churn can spike. If regulators in the future feel they were too lenient, they may come back later with tougher rules. If creators feel exploited, the best ideas migrate elsewhere. None of this shows up in the first-day merger presentation, but it shows up over 5, 10, 15 years in the form of lower growth and thinner margins. The more politics permeates these corporate decisions, the more tempted leaders are to pursue short-term influence over long-term trust. A company might accept editorial compromises or signaling gestures just to appease a current administration or smooth this one merger, but administrations change. Political moods flip. Commitments made under one alignment can become liabilities under another. Long-term capital hates that kind of whiplash. The valuation you pay today may be anchored to a political environment that will not exist by the time your real returns are due. So if you are a rational investor, you should be asking not just, will this deal close, But what kind of world does this deal lock us into if it does? A world where the path to growth for media platforms runs through political favor rather than product excellence is a world with thinner, more fragile equity premiums. You can still make money in that world, but you must demand a higher margin of safety, and you must be more willing to walk away when the price demands blind faith in future goodwill. By the time we reach the fourth act of this story, speculation will be running hot. Will the Department of Justice sue to block the merger? Will the European Commission demand painful divestitures? Will public pressure, activist campaigns, and rival lobbying nudge regulators into drawing a hard line? Or will the deal be approved with tough conditions, celebrated as a triumph of modernization, and quietly used as precedent for even bigger consolidations ahead? No one can know in advance. But you can prepare by understanding what is actually at stake. What's at stake is not just whether Netflix gets more content. It is whether one entity can sit at the crossroads of so much of the world's scripted storytelling, with political gatekeepers helping decide the terms. Every future bidder will study how this plays out. If the message is meet with the president, accept some off-a-balance sheet concessions, promise to adjust news and culture in subtle ways, and your mega merger goes through, then that becomes the new operating manual for corporate ambition. Investors should not ignore that. It alters the risk profile of the entire media sector. For viewers, the near-term outcome might even look appealing. More shows under one roof, bigger budgets, grander universes of content. But over time, less competition often means fewer experiments, less weirdness, less genuine creative risk-taking. When only a few giants remain, they optimize for safety and scale. That may satisfy quarterly earnings, but it rarely produces the kind of innovation that surprises the world. A portfolio that depends heavily on these giants needs to recognize that creative stagnation can be just as dangerous as regulatory crackdowns. Both slowly erode the moat investors think they're buying. The strongest companies in the long run are those that do not need political intermediaries to justify their scale. They build such trust with customers, such aligned incentives with creators, and such transparent relationships with regulators that their size feels earned, not engineered. If this Netflix-Warner merger becomes a case study in opaque bargaining, personalized approvals, and deals intertwined with political grievances, it will not deserve a premium multiple, no matter how many subscribers it claims. It might still make money, but it will do so on thin ice. So here is how a patient investor should think about it. First, ignore the buzz about transforming entertainment forever. Those phrases show up in almost every mega merger press release. Focus instead on three questions. How concentrated will market power truly be after this deal? How politicized is the approval path? And how resilient will the combined company be if the political winds turn against it in 5 years? Second, remember that regulatory risk is not a one-time event. Even if the deal passes, the same arguments about monopoly power can resurface later in the form of new rules and investigations. Third, demand a price that compensates you for all this uncertainty. If the stock runs far ahead of realistic, de-risked expectations, have the discipline to let others chase the story. In the end, politicians, executives, and regulators will all claim they are protecting the public interest, defending competition, or building the future of media. Some of them may even believe it. But capital has its own language. It rewards durable trust and punishes quiet coercion. It flows towards systems that feel fair and away from ones that feel rigged. This deal sits right on that boundary if it is handled with transparency, humility, and real respect for competition. It could strengthen the sector and produce lasting value. If it becomes just another example of power trading favors in the shadows, then no matter what the headline valuation says, the smart money will eventually treat it as a warning, not an opportunity. And that's the part most people forget. Markets don't move on press conferences alone. They move on what people believe about the rules behind those press conferences. When those rules look stable, capital relaxes. When they start to look negotiable, capital tightens. You don't have to predict every twist in this Netflix-Warner saga. You only have to remember that in the long run, trust, not theater, is what compounds.